An array of financial regulation has come into force in recent years, some in response to the financial crisis, others as part of the natural evolution of markets. The fund management industry in the UK, in particular, has been the target of regulators as they seek to better protect investors. For example, the Alternative Investment Fund Managers Directive, AIFMD, came into force in July. It compels asset managers to set risk limits on the assets they buy and places strict reporting requirements, such as detailing the assets they hold on their books. Yet the rise in red tape has sparked concerns about the extra demands on compliance and risk management.
For sure, there's been a massive increase in costs that the industry's had to bear in terms of dealing with extra regulation. All sorts of numbers are banded around and being published. So AIFMD, for example, AIMA quoted a figure of $6 billion for the cost of implementation. MiFID II, another $500 million. FATCA, $10 billion. So there's huge numbers being quoted. I don't know whether those numbers are right or wrong, but what I do know is that the clients and organisations that we work with are putting significant resources, spending significant amount of money.
Aberdeen Asset Management is one of the UK's largest investment managers. Its chief executive says the impact of these new rules has been significant.
I think regulation has obviously had an impact on groups like us. We've had to put more resource into compliance, but I suppose luckily for us we're big enough to be able to absorb the impact of that. And in some ways I think regulation's been good for the industry. It's made us financially stronger, it's made us able to withstand shocks to the system better.
While the UK's biggest asset management groups look well placed to cope with regulation, smaller boutiques face different challenges. Some worry that extra compliance costs will hit their profit margins.
So one of the unintended consequences we fear of the new regulation is a contraction in the industry because of the barriers to entry for the smaller players and perhaps some of the pricing pressures which will give an advantage to the larger players who can make more efficiencies and clearly have a louder voice in the market.
Yet according to one of the smaller players, fixed income boutique Glendevan King Asset Management, it will be the middle market fund managers that feel the squeeze.
Yes, of course, there will be an extra burden. Every small asset management company will have to assess their cost base and to see if they're profitable. If we found out that the profitability is not enough, given the capital allocated to the business, there might be some alliance or there might be some consolidation. We will see either small niche player continuing in a very narrow market, or large institution. Probably the middle ground will be more impacted than the other.
Whether you're running a global asset manager or a niche fund, one thing everyone connected with the industry seems to agree upon is the likely impact of the new regulations on returns.
I think what is very clear is that the profitability of investment management firms is getting squeezed. Their cost base is increasing as a result of the extra compliance costs and implementation costs of these new regulations. So their margins are under significant pressure.
This has led some asset managers to seek out new opportunities in areas such as shadow banking to fill the funding gaps left when traditional lenders were themselves subject to increased regulation.
Banks have had to contract in size over the last 4 or 5 years, so the opportunities for shadow banking, infrastructure, etc. are immense for pension funds and fund management groups, and it is something we're looking at all the time. But it's a difficult area to sort of go into lending money to companies. It's a high cost area.
But there is no guarantee of success. The lower margins, meanwhile, not only make the fund management industry less profitable, it also potentially cuts returns for the very investors the regulations are meant to protect.
Investment has a risk element to it, and if you move away from that and become too risk averse, then the returns will reduce. Will the returns in the fund be as high? Possibly not, so the investor may suffer. The returns to the managers may also be slightly diluted.
Regulation is creating a safer world for investors, but with that comes extra compliance costs, risk aversion and a greater burden for asset managers. It also means that the high returns common before the financial crisis are unlikely to be replicated. This is David Oakley for the Financial Times, London.